Right. So you guys wanted a deep dive on the psychology of money. So that's exactly what we're going to do. Thanks for sending over these excerpts.
Yeah.
Really excited to dig into this one.
It's a good one.
I think a lot of the stuff in here is stuff that people, kind of maybe know intuitively.
Right.
But to see it laid out, I think it's going to be really helpful for a lot of folks, I hope.
Yeah, absolutely. I think, the psychology of money is something that's not talked about enough.
Right.
We always focus on like the technical aspects of it,
Right.
like what stocks to buy, how to invest.
Right.
But the reality is that our behavior with money is so much more important.
Yeah.
That's really what determines our success.
I think that is a perfect way to kick things off. So let's do it. The Psychology of Money by Morgan Housel. Let's dive in and see what we can uncover.
Sounds good.
All right, so just to kind of frame things up for everybody, the mission for today's deep dive is to explore this really interesting disconnect, like this gap between being smart and actually being successful with money. Because it turns out knowing what you should do with your money is totally different from what actually happens in your head when you try and do it right.
Absolutely, yeah. You can read all the books, listen to all the podcasts, but if you don't understand the psychological factors at play, you're not going to get very far.
Right. And you think about it, so many smart people work in finance,
Yeah.
right? I mean, it attracts these brilliant minds.
Oh, yeah.
And we have tons of data these days. I mean, more information than ever before. But has that really made us better investors on average, like as a whole?
No, not really. I mean, the data on that is pretty mixed.
Right.
Some studies show that people are actually worse off now because of all the information overload.
Makes sense. So that kind of sets the stage for what we're talking about today. Let's start with a couple of these real-life stories that are in your sources that really highlight this gap.
Yeah.
The first one's about this tech executive, right? Like a true genius when it came to technology. He designed a core component of Wi-Fi, built and sold multiple companies, incredibly successful.
Right. Like on paper, this guy had it all figured out.
Totally. But when it came to his own money, his personal finances, Housel describes his behavior as a mix of insecurity and childish stupidity.
Oof. That's harsh, but probably accurate in some cases.
Right. Like we're talking flashing huge stacks of cash, bragging about his wealth constantly. And what happened in the end? He went completely broke.
It's almost like he was trying to prove something, he needed that external validation to feel successful, even though he already was.
Right.
It's kind of sad, actually.
Totally. And then you have this complete opposite story, right? Ronald Reed, he was a janitor, passed away back in 2014. But here's the thing. He had over $8 million when he died, more than most people.
Wow.
And no one who knew him had any clue.
A secret millionaire janitor. That's amazing.
I know. No inheritance, no lottery winnings, nothing like that. Just decades of consistently saving money and patiently investing in really solid companies.
That's the power of compounding right there. It's not flashy, it's not exciting, but it's incredibly effective over time.
Exactly. So we have these two guys, right? Like one, a brilliant tech mind, the other, a janitor. And in the end, it's the janitor who ends up with more money. Really shows you that being successful with money isn't just about intelligence or even knowing the right strategies. It's about your behavior and how you manage your emotions around money.
Exactly. It's about having the discipline to stick to a plan, even when things are tough.
Right. And I think there's one more story in your sources that I wanted to touch on just to, drive this point home even further. This one's about another tech executive who built this crazy mansion. I mean, like a ridiculous mansion. 11 bathrooms, 2 elevators, the whole 9 yards. Then the 2008 financial crisis hit, and he lost everything.
Oh, wow.
Yeah. He had all his debt. A lot of his money was tied up in things that were hard to sell quickly. And just like that, gone.
It's a reminder that even if you do manage to build wealth, you can still lose it all if you're not careful.
Right.
Yeah.
So all of these stories, they really set the stage for this core concept from Housel.
Yeah.
Your personal relationship with money is unique. Your own history with money. It shapes how you see things, how you make decisions, even if you don't realize it.
Absolutely. I think we all have these money scripts, these unconscious beliefs about money that we've developed over our lifetimes.
Right. And your personal history with money, it might seem insignificant compared to the entire global financial system.
Right.
But it has this massive impact on your perspective.
100%.
Let me give you an example. Imagine someone who grew up poor. Right. Compared to someone who grew up as the child of a wealthy banker. Their entire outlook on money, saving, risk, It's going to be completely different.
Yeah, and it's not just about how much money your family had. It's about the messages you received about money growing up.
Totally. Like, were you taught to be frugal? Were you taught to invest? Were you taught that money is evil? All those kinds of messages shape how we see things.
Absolutely.
And think about someone who lived through a period of really high inflation. Like, prices were constantly going up. They're going to feel very differently about saving and investing compared to someone who's only ever known relatively stable prices.
For sure. I mean, someone who experienced hyperinflation might be very reluctant to hold on to cash.
Right, right. Or even someone who was a stockbroker during the Great Depression.
Yeah.
They're going to have a completely different perspective on market risk than someone who started their career in tech during the dot-com boom of the late 90s.
Yeah, absolutely. Their experiences are going to shape their risk tolerance.
Right. And the book actually mentions this fascinating study by these economists, Malmendier and Nagel. They looked at like 50 years worth of financial data and found that an individual investor's willingness to take risks was significantly influenced by their personal experiences, not just by their intelligence or their level of education.
That's really interesting. So it's not just about understanding the concepts, it's about how those concepts feel to you based on your own life.
Right, exactly.
Right.
Like, you can know all about risk diversification in theory, but if you've personally experienced a major market crash, that knowledge is going to feel different.
It's going to be more visceral,
Yeah.
more emotional.
Totally. And Housel brings up another example, Ben Gross, the famous bond manager. Even he admitted that his incredible success was likely, at least in part, due to the huge drop in interest rates that happened during his career.
So he was in the right place at the right time.
Totally. But imagine if his dad had been a bond manager, right? Someone who'd lived through much higher inflation. I bet he would have had a very different view of bonds as investments.
Yeah, maybe bonds wouldn't have seemed so appealing to him.
Right. And I think, another really interesting thing to think about here is how these different economic and historical contexts shape our financial beliefs.
Yeah, for sure.
Like, someone in Australia, they haven't had a recession in decades.
Yeah.
That's a completely different economic backdrop than someone in the U.S. or other parts of the world that have experienced multiple recessions.
Definitely. And that's going to impact how they think about risk, how they save, how they invest.
Totally. And Housel really drives this point home with this powerful anecdote, this story about this guy whose aunt worked in a Chinese factory.
Okay.
And the New York Times, they ran this article criticizing the sweatshop conditions. And, a lot of American readers, they were, of course, like, outraged. But the aunt, she had a totally different perspective. She had previously worked as a prostitute. And so compared to that, the factory job was actually a huge step up for her.
Wow.
Right.
That's a powerful example of how our personal experiences can shape our views.
Totally. It's a reminder that what seems outrageous or unacceptable to one person can actually be a huge improvement for someone else, depending on their background.
Yeah, and I think that's a really important point to remember when we're talking about money, especially when we're giving advice or judging other people's financial decisions.
Exactly. We all have these unique mental models, these frameworks for understanding the world that are based on our own experiences and the information we have access to.
Right. And those mental models might be flawed, they might be based on incomplete or even inaccurate information, but they're what we use to make decisions.
Right. So even if a financial decision seems totally irrational from the outside, it might actually make perfect sense to that person given their own understanding of how things work.
Exactly.
And I think this helps explain things like why people with lower incomes might buy lottery tickets.
Right. That's a classic example.
Yeah, from a purely statistical perspective, it doesn't make much sense.
Right. The odds are incredibly low.
Right. But when you consider their circumstances, their lack of other opportunities, maybe the lack of financial safety nets, it starts to make a bit more sense why they might take that risk.
It's a long shot, but it's a shot.
Exactly. So moving on to another really important idea from the book, this intertwined nature of luck and risk.
Yeah, those two go hand in hand.
Totally. And Housel makes this argument that external forces, things outside of our control, they play a much bigger role in our financial outcomes than we often want to admit. There's this NYU professor, Scott Galloway, and he has this great quote, "Nothing is as good or as bad as it seems." It's like this reminder that both our successes and our failures are often influenced by things beyond our control.
I love that quote. It's so true.
Right. It's easy to look at someone who's really successful and think, oh, they must be so smart, so talented. But we often overlook the role that luck played in their journey.
Yeah, and on the flip side, we tend to blame ourselves for our failures, even when external factors were at play.
Right. And I think the story of Bill Gates is a perfect example of this.
Yeah.
He's obviously incredibly smart and driven.
Yeah, for sure.
But he also had this amazing stroke of luck. He went to Lakeside School, and back in 1968, they were one of the few high schools that actually had a computer. That access gave him this incredible advantage, this head start that most other people just didn't have.
That was a huge turning point for him.
Totally. And Gates himself has acknowledged that there might not have even been a Microsoft without that lucky break.
It's amazing to think about how different things could have been.
Totally. And then, you have this really sad story of his friend Ken Evans, who was just as ambitious, just as smart, but he died in a rock climbing accident when he was young.
Oh, wow.
Right. And it just shows you how random and unpredictable life can be.
Yeah, it's a reminder that sometimes things are just completely out of our control.
Right. And it's so interesting how, when we see other people's success, we tend to downplay the role of luck. Like maybe we don't want to admit how much chance plays a role in things because it makes us feel envious.
Right. It's easier to attribute their success to talent or hard work, because then we can feel like we have some control over our own outcomes.
Totally. And then, on the flip side, when we experience our own failures, we often overemphasize our own role in it, maybe to protect our ego or avoid feeling like we're just unlucky.
Yeah, it's easier to blame ourselves than to acknowledge the role of chance.
Totally. And Housel mentions this research by the economist Bhaskar Mazumdar.
Okay.
And this research showed that there's a much stronger correlation between the incomes of brothers than there is between, say, their height or weight.
Really?
Yeah. Which suggests that your family's socioeconomic background, the opportunities that you're exposed to, they have a massive impact on your financial trajectory.
It makes sense. It's not just about individual effort. It's about the environment you're born into.
Totally. And then there's this example of Cornelius Vanderbilt. I mean, he's known for being this incredibly successful businessman. But a lot of his success was actually due to him flouting the law.
Oh, wow.
Right. Like bending the rules, sometimes breaking them outright. And while it worked out for him, it's a reminder that that kind of behavior is not a recipe for success for most people.
Yeah, for every Vanderbilt, there are probably 1,000 other people who tried similar tactics and failed miserably.
Right. It's a high-risk, high-reward approach. And even Benjamin Graham, considered like the father of value investing, admitted that a huge chunk of his success was actually due to one lucky break with Geico stock.
Really?
Yeah. And that investment, it actually went against his own rules for diversification, which is kind of ironic.
Yeah, it goes to show that even the greats get lucky sometimes.
Totally. So Housel's point here is that we should be careful about, drawing broad conclusions from these extreme success stories.
Right, they're not always representative of the average person's experience.
Right. It's like, those stories can be inspiring, they can be entertaining, but they don't always offer the most practical advice for the rest of us.
And I think that's why Housel advocates for focusing on broader patterns and principles.
Right.
Like, what are the common behaviors and habits that lead to financial success for most people?
Exactly. And I love this other quote from Bill Gates. He says, "Success is a lousy teacher. It seduces smart people into thinking they can't lose."
Oh, that's a good one.
It's like a reminder to stay humble, to remember that luck plays a role, and to not become overconfident just because things are going well.
It's easy to get complacent when you're on a winning streak.
Totally, totally. So let's move on to this really important idea of enough. Housel tells this great story about Joseph Heller, the author of Catch-22.
Okay, yeah.
And Heller is at this party with this really wealthy guy, and someone mentions that this guy makes more money in a single day than Heller made from his entire book.
Wow.
Right? And Heller's response is so perfect. He just says, enough. Like one word, enough.
That's brilliant.
I know. And it really highlights this danger of always wanting more, never feeling like you have enough.
Right. It's like that hedonic treadmill where you're constantly striving for more but never feeling satisfied.
Totally. And, Housel uses the examples of Rajat Gupta and Bernie Madoff to illustrate this point.
Okay.
Gupta, he had this incredibly successful career. He was super wealthy, but he risked it all for insider trading. Like for what amounted to a relatively small amount of money compared to what he already had.
It's like he just couldn't stop, even when he had more than enough.
Right. And then, of course, you have Bernie Madoff. I mean, his Ponzi scheme, it's like the ultimate example of someone who never had enough.
Yeah, his greed just destroyed so many lives.
Totally. So these stories, they're like cautionary tales, right? They show you what can happen when you don't have a clear sense of enough, when you're constantly chasing more and more and more.
It's a recipe for disaster.
Totally. And now let's talk about this concept that can be a little counterintuitive, but it's so powerful. Compounding.
Yeah, compounding is like the magic of finance.
Totally. And Housel uses this really great analogy to explain it. He talks about how a small amount of leftover snow can eventually lead to a massive ice age.
Yeah.
He quotes this glaciologist who says, "It is not necessarily the amount of snow that causes ice sheets, but the fact that snow, however little, lasts."
So it's about consistency over time.
Exactly. And it's the same with money. It's not necessarily about making these huge risky bets or trying to get rich quickly. It's about consistently investing, even small amounts, over a long period of time. And that's how you really harness the power of compounding.
It's about letting your money work for you.
Right. Like, think about Warren Buffett. The vast majority of his wealth was actually accumulated after he turned 50, even after he turned 60.
Wow, so it's never too late to start.
Exactly. Time is your greatest ally when it comes to compounding. And it's interesting to compare Buffett to someone like Jim Simons, who actually has had much higher average annual returns than Buffett.
Okay.
But Simons started investing much later in life. So even though his returns have been higher, his overall net worth is still less than Buffett's, simply because he hasn't had as much time for that compounding to work its magic.
Time really is the key ingredient.
Totally. And the book makes this point that even really smart people can struggle to grasp the true power of exponential growth.
Yeah, it's not something that comes naturally to us.
Right. Like the example they give is digital storage capacity. Since 1990, it's increased by a factor of 30 million.
30 million.
30 million.
That's insane.
Right. It's mind-boggling. And even Bill Gates, back in the day, he was like, why would anyone ever need a full gigabyte of storage for email?
It's hard to imagine how much things will change in the future.
Totally. So we've talked about getting wealthy, but let's talk about a different skill, which is actually staying wealthy. Because it turns out those are two very different things.
Yeah, it's one thing to make money, but it's another thing to keep it.
Totally. And the book contrasts these two guys, Jesse Livermore and Abraham Jermansky. Livermore, he was a legendary stock trader, and he made a killing by shorting the market in the 1929 crash.
So he bet against the market.
Yeah. He basically predicted that the market was going to crash, and he made a fortune from it. Jermansky, on the other hand, he was a real estate developer, and he was completely wiped out in the crash.
Oh, no.
Right. So these guys, they had opposite outcomes in the crash. But here's the interesting thing. They both ended up being bad at staying wealthy in the long run.
Really?
Yeah. Livermore, he kept making these bigger and bigger bets. He got into debt, and eventually he lost everything and committed suicide.
Oh, that's tragic.
Totally. So their stories really highlight this idea that survival is the key to long-term success with money.
It's about staying in the game.
Exactly. And the book mentions how there's a lot of turnover on the Forbes 400 list. Like a lot of people who make it onto that list, they don't stay there for very long.
It's not easy to stay at the top.
Right. And even a lot of publicly traded companies, they end up losing most of their value over time.
Yeah, it's a tough world out there.
Totally. So this focus on survival, it's crucial for two main reasons. First, to avoid those ruinous losses, those big hits that can wipe you out. And second, to allow that power of compounding to work its magic over a long period.
So you need to be able to weather the storms.
Exactly. And there's this great analogy in the book about planting oak trees. You know, it takes decades and decades for them to grow into these really magnificent, valuable trees. And it's the same with investing.
Patience is key.
Totally. And the book tells a story about a guy named Rick, who was apparently as good as Buffett and Munger at getting wealthy.
Okay.
But he lost all of his Berkshire Hathaway stock because he was over-leveraged during a market downturn.
Over-leveraged.
Yeah, meaning he had borrowed too much money to invest, and when the market went down, he got wiped out.
Oh, I see. So even if you're a great investor, you can still get into trouble if you're not careful with debt.
Exactly. And I love this quote from Nassim Taleb. Having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs.
That's a powerful quote. Totally. So this whole survival mentality, it boils down to a few things. Prioritize being financially unbreakable so you can withstand those unexpected hits. Understand the value of cash because it gives you flexibility and prevents you from having to sell assets at a loss when the market is down. And remember that consistent good returns over a long period will always beat those occasional big risky returns.
It's about playing the long game.
Totally. And another really important concept from the book is this idea of room for error.
Okay.
You can have the best financial plan in the world, but if it can't handle a little bit of reality, it's not going to be very useful. And the reality is that life is full of surprises, things we can't predict or control.
Yeah, life rarely goes according to plan. Right. So a good plan needs to have some built-in flexibility, some room for error, and that can take different forms. Maybe it's having a frugal budget, so you have a cushion for unexpected expenses, or maybe it's having a flexible mindset so you can adapt to changing circumstances. Or maybe it's having a longer-term timeline for your goals, recognizing that things might not always happen as quickly as you'd like.
It's about giving yourself a margin of safety.
Exactly. And this idea of room for error, it's not about being overly conservative or avoiding risk altogether. It's about intelligently increasing your chances of success and survival at any given level of risk you're willing to take.
I like that. It's about being smart about risk.
Exactly. And Jesse Livermore, the guy we talked about earlier who made a fortune shorting the market, he actually said something really interesting about this. He said, "I sometimes think that no price is too high for a speculator to pay to learn that which will keep him from getting the swelled head."
So he learned the hard way.
Totally. He called overconfidence an expensive disease.
And it is. Overconfidence can lead to some really bad decisions.
Totally. So moving on to another really fascinating concept. Tails, you win. And the book actually kicks off this section with a quote from Brad Pitt.
Oh, Brad Pitt.
Yeah. He was accepting an award at the Screen Actors Guild Awards, and he said something like, "I've been doing this for 30 years. Some projects work, some don't. There's no reason to belabor either one. Just get on to the next."
That's a great mindset.
Right. And it applies to so many things, especially finance and investing.
Yeah, you're not going to be right all the time.
Totally. And Housel uses the example of Heinz Berggruen, this super successful art dealer.
Okay.
And Berggruen, he bought a ton of art throughout his career, but apparently something like 99% of it turned out to be worth very little.
Wow, so he was wrong most of the time.
Totally. But the 1% that became really valuable, like works by Picasso and stuff, those pieces were so valuable that they more than made up for all the other stuff.
So it was all about those few big wins.
Exactly. And this gets into the concept of long tails. It's this idea that in certain fields, the extremes, the outliers, they have a massive influence on the overall results.
So it's not about being right all the time. It's about being right when it really counts.
Totally. And this applies to so many things. Like, think about Walt Disney. He had a lot of early struggles. Some of his early cartoons actually lost money.
Really?
Yeah. But then he hit it big with Steamboat Willie.
And the rest is history.
Totally. And then you have the opposite story. Carolco Pictures. They were the studio behind Rambo, Terminator 2, like huge blockbusters.
Okay.
And they went public really successfully, but then they had a string of flops and they went bankrupt.
Oh, wow. So even a track record of success doesn't guarantee long-term survival?
Right, right. And Housel actually has this great definition of an investing genius.
Okay, I'm curious to hear this.
He says it's someone who can do the average thing when everyone else is going crazy.
So it's about staying calm and rational when everyone else is panicking?
Exactly. And he makes this point that it's totally normal for a lot of things to go wrong in business and investing. Even the best stock pickers, they're not going to be right all the time.
Yeah, no one has a perfect track record.
Right. Like Peter Lynch, he was this legendary investor. He said, if you're terrific in this business, you're right 6 times out of 10.
Wow, that's lower than I would guessed.
Right. And it really highlights that you don't have to be perfect to be incredibly successful.
Yeah, it's about managing your losses and letting your winners run.
Totally. And I think, Amazon's a great example of this. They had the Fire Phone, which was a massive flop.
Yeah, I remember that.
But then they had Amazon Web Services, which has been this massive success.
Right, so one big win can more than make up for a bunch of losses.
Totally. And Netflix, they actually intentionally aim for a higher cancellation rate with their shows.
Really?
Yeah. Because they know that if they're not taking risks and having some failures, they're not going to find those truly big hits.
That's interesting. So they're embracing failure as part of the process.
Exactly. And I think the key takeaway here is that we often only see the finished product, the success, and not all the failures that happened along the way.
Right. It's like that iceberg analogy where you only see the tip above the water.
Totally. And George Soros, he has another great quote here. He says, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong."
So it's about the magnitude of your wins and losses.
Exactly. You can be wrong half the time and still be really successful as long as your wins are bigger than your losses.
Makes sense.
And the book ends this section with this really thought-provoking idea.
Okay.
They remind us of the sheer improbability of our own existence. Like the fact that we're even here, it's statistically this incredibly long-tail event.
It's kind of mind-blowing when you think about it.
Totally. And I think it's just a nice reminder to be grateful for what we have and to appreciate the role that chance plays in our lives.
I like that.
So shifting gears a little bit, let's talk about this really interesting idea that perhaps the highest form of wealth is not actually about how much money you have, but about the degree of control you have over your time.
That's an intriguing idea.
Right. Because, a lot of people, they want wealth because they think it'll make them happier. And a big part of happiness is having control over your life, your choices, how you spend your time.
Yeah, I think that makes a lot of sense.
And there's this psychologist, Angus Campbell, who did all this research on well-being. And he found that happiness wasn't always directly correlated with things like income, geography, or education.
So it's not just about external factors.
Exactly. And I think about, my brief experience as an investment banking intern.
Okay.
The work was interesting. The pay was great. But I was miserable because I had absolutely zero control over my time.
Yeah, those long hours can be brutal.
Totally. And I
Gotcha.
think there's this psychological concept called reactance. Yeah. It's like this idea that people resist being told what to do. Like, even if they might be willing to do it voluntarily, if someone tells them to do it, they suddenly don't want to anymore.
Oh, yeah, I've definitely experienced that.
Totally. And I think this plays into how we feel about work and how we spend our time. Like, if we feel like we're constantly being told what to do, it can be really draining.
Yeah, even if it's something we enjoy, if we don't feel like we have a choice, it can become a chore.
Right. And it's so interesting how much progress we've made as a society in terms of physical comfort and convenience.
Yeah, we have so much more stuff than we used to.
Totally. But maybe we haven't made as much progress in how we actually spend our time.
Right, like we might be more comfortable, but are we happier?
Right, right. And Housel uses the example of John D. Rockefeller.
Okay.
As he got wealthier, his main job was essentially to think and make strategic decisions. And that required a lot of solitude and quiet time.
So he was spending his time thinking.
Exactly. And to other people, it might have looked like he was just relaxing or being lazy.
But that was his work.
Totally. And there's this kind of irony, right? Like, we often want wealth so that we can be admired, but then people often end up just admiring the wealth itself, the stuff we buy, rather than the person who has it.
That's a good point. It's like people focus on the external symbols of wealth rather than the internal qualities that might have led to that wealth.
Totally. And this leads perfectly into this other idea that wealth is often what you don't see.
Okay.
Like, we tend to judge wealth by what's visible, the fancy cars, the big houses.
Right, the stuff that's on display.
Totally. But true wealth, it's often what you don't see. It's the money that's invested, the savings that are accumulating, the assets that haven't been spent. Expert.